Welcome to this weekly installment of the Whitaker Myers Wealth Managers, What We Learned in the Markets This Week. My name is Puri. I'm the Chief Operating Officer and Co-Chief Investment Officer here at Whitaker Myers Wealth Managers. Thank you so much for tuning in. This week, U.S. stocks in aggregate ended the week slightly lower after a choppy session. The S&P 500 fell by 0.52%. The Nasdaq Composite fell by 0.92%. However, beneath the surface, leadership continued to rotate. Small caps and value outperformed while defensives led the upside and financials lagged amid policy noise like proposals to cap credit card rates. Bonds were mixed with longer maturity Treasuries outperforming shorter ones as the curve adjusted to delayed rate cut expectations and solid but fragmented economic data. So let's talk about this in more detail. First, let's hop into our discussion this week, talking about our key market indicators, as well as we'll continue our discussion by reviewing the contributors and detractors of the market, all while looking at both the equity side and the bond side to provide a more comprehensive view of market movement and the impact to your portfolios. So with that, let's hop right in. First, each week we review the Atlanta Fed seasonally adjusted GDPNow report to gauge in real time how fast our economy is growing. This week, the Atlanta GDPNow report shows a projected massive 5.3% growth as of January 14th. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of the labor market. This week, initial claims ended at 198,000, while continuing claims ended at 1.88 million. Next, we're watching mortgage rates closely to see how home affordability is trending. This week, we saw some positive movement again in mortgage rates, where the 30-year and 15-year rates ended about 10 basis points lower than where they were last week at 6.06% and 5.38%, respectively. Next, we'll look at investor sentiment. Now, one component of investor sentiment is the bull to bear spread. And this week, the bull to bear spread ended at a positive 21.26%, indicating that investors are feeling much more bullish with the current environment. Another measure of investor sentiment is the VIX, or volatility index. This week, the VIX ended at 15.86, highlighting low volatility, low fear, and more stability in the market. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 4.4% probability of a 0.25% decrease and a 95.6% probability of no decrease in January. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended negative 0.52%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, had another great week, ending positive at 1.61%. And the MSCI EFA, which tracks international stocks of developed countries across the globe, excluding the US, was also positive by 0.93%. And the winner this week goes to aggressive stocks. Well, remember, we watch these market and sector fluctuations weekly to show you in near real time not only how markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. Now, if you'd like an unbiased review of your portfolio, please do not hesitate to connect with one of our advisors today. And with that, let's jump into our discussion around the contributors and detractors that move these market indices in the past week. All right, let's talk about the contributors and detractors for the market movement in the past week. And let's specifically start with equities. As you saw on the last slide, small caps and mid caps had a great week. Individually, small caps rose by 1.28%, mid caps rose by 0.77%. We also saw value stocks go up by 0.38%, and all of them outperformed large caps. Large caps fell by 0.69%. And we continue to see this rotation from large cap to small and mid caps stocks, improving market breadth, which is great to see. Consumer defensives also led all sectors by 3.7%, followed by real estate, which was also up by 3.6%. as investors favored stable earnings and rate-sensitive areas amid Fed uncertainty. We also saw some individual stocks do very well in this market. Biotech and select growth names like Moderna, Venture, and Intelia were all up over 20%. Energy stocks gained over 2% for the week, which were fueled by rising oil prices amid Iran tensions, while Bitcoin hit highs since November, supporting crypto-related equities. Now, the key detractors, we briefly mentioned this, that large cap stocks fell by 0.69%, pressured by the rotation and policy risks like Trump's credit card rate cap proposal. Financial services also dropped by 2.09%, and communication services fell by 1.98%, as banks and telecom face headwinds from regulation, competition, and broader risk off moves later in the week. Now, on the bond side, the major contributors were seen on both ends of the bond spectrum. So larger maturities, excuse me, maturity treasuries and corporate bonds outperformed as shorter yields rose, while longer ones declined slightly, steepening the curve and aiding intermediate and long duration strategies. The U.S. 10-year yields remained stable around 4.2%. Now, the key detractors in the bond market were related to shorter maturity treasuries, as yields rose as markets priced out near-term rate cuts. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Now, before I sign off, I want to take this time to invite you all to a webinar that we're hosting next week. As we step into a new year, many of us are asking the same question. How can I take better control of my money and make real progress towards my financial goals? Our next webinar on January 26th is designed to help you answer that question with clarity and confidence. You'll be guided by Tim Hilterman, our CFP, our Chief Financial Planning Officer, and Joe Maines, who is our financial coach and an advisor on our team. Both of them are two very experienced professionals who work daily with individuals and families to turn financial stress into structured, achievable plans. Together, they'll walk you through the practical budgeting strategies, common pitfalls to avoid, and actionable steps you can take to immediately align your spending with what matters most. Now, whether your goal is to get out of debt, build savings, or simply feel more comfortable and have more control of your finances, this session will give you the tools and perspective to start the year strong and move purposefully towards financial freedom. You can register for this webinar at the bottom of the page, at the bottom of our website, or you can click on the link in the description below, and you can register there. So with that, thank you everyone for watching. Thank you for joining today. We look forward to seeing you